Okay, good afternoon. Thanks for joining us today for our second New Knowledge series of 2022. My name is Sandy Ratliff. I'm with Virginia Community Capital and so happy to be here and partner with the Virginia Highland Small Business Incubator and the Washington County Chamber of Commerce on this program. It's hard to believe that we've been doing this since 2014, and it's a project that we started to support the Washington County Business Challenge that's going on right now. So we're in our 9th year for that. Before I turn it over to our moderator for today, just wanted to do a few housekeeping things to let everybody know that today's session is being recorded for education and training purposes, and it will be available on the Virginia Highland Small Business Incubator's Facebook page and then our YouTube channel, New Knowledge, and it will be up in a couple hours after the session. Also, in an effort to keep everything flowing, we do have everyone muted. But however, if you have a question for our presenter today, please do not hesitate to put those in the Q&A section and in the chat room, and we will be addressing those. And Eddie can, however you want to do it, if you want to do it live, do it as they come in, or if you want to do them at the end, that's totally up to you. But I'm going to turn it over to Kathy Lowe, who is the Executive Director of the Virginia Highland Small Business Incubator. And Kathy is going to introduce our presenter today and moderate. Thanks.
So it is my pleasure. I'm very excited to have Eddie Neely, who is the Chief Financial Officer for Food City, presenting this budgeting session. Eddie was with Alpha Natural Resources as a CFO, and he retired and decided he liked working, and so he came back to Abingdon and took another CFO position. And that's how Eddie rolls. He's very knowledgeable, and he is going to make himself available to you all at the end. So have your pencil and paper ready. He's going to tell you how to contact him if you have any questions after the session when you're developing your financial projections for your business plan. Without further ado, my friend, Eddie Neely.
Hey, Kathy, thank you very much. And Sandy, thank you. It's a pleasure being here this afternoon. Kathy and I go back a long way, and I helped her get through school, I think, on the accounting side. So it's a pleasure to be able to talk to you all and hopefully bring you some knowledge of, got this titled up here. I hope everybody can see my screen okay. Financial projections, but I put in parentheses budgeting, and it's really what it is. It's coming down to putting your business plan into a descriptive roadmap that's in a normal numbers format. So you'll be able to see what you're thinking about and put it down into numbers and translate that into an overall plan. Of course, the purpose of a budget is to analyze the profitability and economic feasibility of your business. So that's the whole intent of a budget, is to quantify what you've been thinking and what you put down on paper. What I've done here on this first slide, I've got a little outline that I went through and started out with point zero. And this is very critical. I think you need to step back and analyze your business. If heard correctly, Kathy says everybody's developing a business plan to part of this business challenge. And that plan then that you've gone through, I hope I can bring some attention to that, some things you should focus on in that plan that then we can take and translate into some income statements, some budgets, and stuff like that. So the next part, I will talk about capital needs. I try to do budgeting on a 3-year format. I think about the current year as being monthly, and then forecast out 2 years past that just on an annual basis. So the capital needs of the company, long-lived assets such as machinery, equipment, land and buildings that you might have to buy, to get your business up and running. Then we'll do a statement of income. Again, I said 1 year by month and 2 additional years by year. I've got a couple of spreadsheets here that I'll show, and I can share some other data with you as needed, some things I've got in templates and things like that I might be able to share. We'll then do a statement of cash flows, which is really the key to the business. You want your cash to be flowing and generating cash, make sure you're earning money and your money's going to the right spots. And then we'll talk about computing your financing needs. All companies are either financed two ways, either with debt or equity. And I'll talk about how we should look at that and how you calculate that part of the business. So with that, let's get into some detail. Let me flip to the next tab here on my schedule. I'm calling this the planning phase. This is where you analyze your business. Start off, review your historical sales and expenses. It's pretty easy to do if you've got a company you've been in operation for a while. If you haven't gotten anything yet, if you've just got a business plan, you're not really running a company, you can't really use this step, but you can look at other companies that may be out there in similar lines of business you're thinking about doing and seeing how they have been operated. Once you assess the current economic climate, everybody's heard about interest rates, going up here potentially. And everybody I know has heard about inflation, supply chain issues, everything that's going on in the current economic environment that impacts every business, regardless of large or small. Check for new competition. As you're thinking about a business, we do this here at Food City. We always, in every area we operate, we look at the new Walmarts coming up. We look at the new Publix coming into play, any new Krogers, any of those companies that might be stores that are not in good shape, that might be remodeled. We also look at stores that might be closing, that are going to come out of our area that probably would enhance our sales. We definitely check for new regulations. Think about Virginia just had a recent minimum wage increase. I had one last year and had one that started here in January. I think we're up to around $11 an hour right now on a minimum wage. Review your manpower needs. We here at Food City are struggling to find qualified people. We have a big distribution center up in Glade that we are probably short 20 people up there, and these are good paying jobs, and we just can't find people. We have job fairs at our stores that we'll hire 300 or 400 people at a time, and half of those will be gone in 30 days. So it's really difficult finding people right now. Supply chain inventory needs, you need to assess, what kind of inventory you're going to carry, the lead time on getting that inventory in place. Right now we're having issues with our suppliers, COVID reactions, people out in their plants and stuff that, the whole supply chain gets jacked up because of that. Then you step back, and I assume you developed already what your product's going to be and how you're going to operate your business. So you need to forecast your sales. Be realistic, and you can forecast your sales by looking at your competitors, the marketplace, see what you might be able to sell your product for, and then you forecast your expenses. And again, here too, you'll be looking at what it takes to operate the company to sell your product. And again, caution everybody to be realistic in your projections. You don't want to oversell yourself here, put down some numbers on paper that are not realistic. Let me talk about property, plant, and equipment. These are the long-lived assets I was speaking of. Here you plan for new and replacement equipment, and again, over a 3-year time period. Need to consider, as you're looking at that, delivery cost, installation costs, lead times, et cetera, to figure out what the total cost of that equipment will be as you get ready to install it in your company. And these type of assets are expensed over multiple years. Equipment, for instance, typically has a 7-year life, and you appreciate that for book and tax purposes over that 7-year period. Buildings, of course, they go out 25, 30 years, and land, if you have any land you're buying, you don't depreciate that at all. It stays on your balance sheet as going forward. And of course, you also you can look at leasing options for equipment that may be more advantageous than buying equipment outright. And you can go through an analysis to do those type things. Next, I'll pick out a little income statement here. This is very simplistic. I was a little lazy. I didn't do the first year in the 12-month format that I preach about, but it's very easy to do once you get figure out what your numbers are going to be. Your business may be cyclical too. It could be seasonal. You may do more business in the spring and summer than you do in the fall and winter. So you factor that into your monthly forecast for sure. I started out with this entity here, got years 1, 2, and 3, of course. Sales, $40,000, going up 5%, or excuse me, up $5,000 the next year, and then going back down to $40,000 in year 3. Start off with beginning inventory values, what you're purchasing, subtotal of a potential cost of goods, end up with your ending inventory, then you get to your cost of sales. Of course, cost of sales compares to your sales number to come up with your gross profit. And that's the profit you generate from your sales, from the cost of your product versus what you're selling for. So you can see here, pretty flat here on this company, $20,500 a year, except for the last year they had a little difficulty in year 3. And you can use these budgets you're putting together for income statement purposes, and you can do a lot of what ifs. You can factor in higher sales, higher costs, higher expenses, and see how it plays out for your company to see, which one, is sort of your best fit. Back in my prior lives, we always had a worst case, a middle case, and a best case scenario for our budget, so we could see, downside, upside potential for how we can operate the company. Then I just listed here some various expenses, salaries and wages, payroll costs, supplies, expenses, repairs and maintenance, utilities, rent. Depreciation, of course, is related to the property, plant, and equipment that you have bought, and then this other category. Summed up those expenses, of course, to come up with then an operating income. Gross profit minus those expenses gives you your operating profit. And then income tax in here, I just used a 25% factor, I think, for the company in this case. So that comes down to companies making $6,000 a year roughly. And then in year 3, with the downturn in sales, increase in cost, things have turned downhill. So we have a little bit of a loss. Any questions that you might have? I hope you use the chat function and everything, or we can do some just Q&A at the end.
I don't see any questions yet. So folks, be sure you put your questions up there for Eddie.
Next, let's take this income statement and generate a cash flow statement. Here's our statement of cash flows, again, in the same yearly format. You start off with your net income from the prior sheet, and you see that just flows through as we presented over there, and that's after tax. Then we make adjustments for non-cash items. And particularly the biggest non-cash item we had in this particular company was a depreciation expense. And you get to add that back to your profit to help you with your cash generation, because it's really a non-cash expense in your P&L. Then you have to account for changes in working capital. And working capital, of course, is current assets, which typically accounts receivable, inventory, prepaid expenses, less current liabilities, typically accounts payable and accrued expenses for payroll, property taxes, no such things. So you make an investment in working capital in your company, and this takes into the change of that working capital from year to year. In this case, inventories went up $1,000. In year 2, accounts receivable went up a little bit, inventories went up again. And then the same thing happened, inventories and accounts receivable went up again in year 3. And those end up taking operating cash, because you got to fund those from your operations to carry your inventory, carry your accounts receivable, and pay your bills. So this summed up on a simple basis here of cash provided by operations. And here, this company in year 1 generated $9.3 million, $9.3 thousand of cash flow, $10,000, and then a small amount, around $4,000 in year 3. This company also, the next phase of cash flow statement is investing activities. And you can see here, this company was buying property, plant, and equipment in every year of operation. And this could have been new equipment. It could have been old replacement equipment. It is equipment that you are buying and paying for. If you're leasing equipment, then you wouldn't have anything here, but it would go up in your operating net income number as a charge for that. So in this case, they spent $5,000 a couple of years and took it down because year 3 was a little paltry for them and didn't have as much cash generation. So they took that down to $2,500. Then we get into financing activities. Debt and equity are the two main ways that you can finance your business. If you have a good business plan in place and a good budget, you can go to a bank and hopefully be able to borrow some money where you don't have to put your own cash into the company. Debt is usually cheaper than equity because the interest rate that you generate from debt is deductible in your profit and loss statement and for tax purposes. And equity, you typically requires a dividend payment to fund that equity because the people who invest money in your company in cash, they want some kind of rate of return on that money. And typically dividends, which are not deductible by a company, are typically paid by an entity like yourselves. So in this case, I did show some dividends here of $2,500 a year. In this case, the company generated positive cash for a couple of years, and then the third year they went negative $1,000. So this cash right here would be in addition to any cash you already had on the balance sheet. So in effect, any cash you had on hand went up by $1,800 in the first year, about $2,500 in the second year, and then went down $1,000 in the third year. My last tab here is the debt and equity calculation. And to do that, you have to forecast a balance sheet. In this case, what I did was look at assuming the cash on hand was $250. Accounts receivable, I computed out looking at the sales. I take the sales on an annual basis, divide it by 360, and assume we'd have accounts receivable out there for about 35 days before people actually pay us. And so I came up with like $8,000. Inventory, I figured that we'd take that much inventory to operate the business on an ongoing basis, taking into consideration lead times and such. And then I had some other assets there of potentially prepaid insurance and such, prepaid taxes. So my total current assets in this case were around $8,000. The company had PP&E already in addition to what it bought. So that PP&E was $20,000. Depreciation had been taken already around $7,500. Part of that's in the P&L already that I'm showing for the 3 years. So the net property, plant, and equipment is $12,500. So total assets right around $20,000. Accounts payable, I computed that based off the expenses the company had, looking at the cost of its goods to buy, and again took the annual number divided by 360 and timed that out to about, I think I used 25 days considering that you may get cash discounts on some of your purchases. A word of note, if you ever are offered cash discounts on purchases, definitely try to take those because the interest rate, say 2% discount for paying 10 days early within 10 days is a big savings on interest for you. So it's always a good way to take advantage of getting cheaper goods, and you don't avoid paying stimulated high interest rate by extending those past those 10 days. Again, I got other accruals there. That's for payroll, other taxes, et cetera. So my current liabilities were $2,700 in this case. So my net working capital in this case is right around $5,000 or so, round numbers. And what I showed here was all this was financed by equity in this case. So the owner of the company had to put in $17,850 of their own money to have this company up and running in this structure right here. So you can see there's a possibility that given the right business plan and the right economics of your business, you can get some debt potentially. Maybe half of that could be in debt, and you can play around here with it and see. So if you layer on debt, you go back and add some interest expense into your profit and loss and go back through all the calculations again. But as I said, debt is typically cheaper than equity in the long run. And right now, of course, interest rates are going up, but there's some advantages out there right now for people to borrow some very good long-term money at low rates. So with that, that sort of sums up my presentation, I think. I know it's simple and a little quick here, but definitely would like to take questions if there are any, or I make myself available for future conversation with anybody as needed.
So Eddie, a couple of, I don't necessarily know if it's questions, but have you sent that PowerPoint to Sandy so that maybe these contestants can use your sheets as a template for what they're working on?
They could.
He did.
Yes,
I got it.
Excel format, so they can use that as needed. And it can be expanded on very easily too. And I do have some other templates I'd be glad to share that I've used in past lives.
So let me ask you a couple of questions for the contestants. Some of them might not know the questions to ask yet. So if you're starting an LLC, this is going to be a more of a tax question, but let's say you're starting an LLC and you put $100,000 of your own money to start that LLC.
Okay.
Let's talk about what that is in accordance with their taxes and how they're claiming that, because a lot of people think that's an expense.
Yeah, it's not. It's an equity investment in the LLC. And what you do there, of course, the entry is you debit cash and you credit equity. And then from there, you start buying assets, or you buy your inventory, you buy your property, plant, and equipment. So you fund those with your $100,000 of equity. The income and expense come into play once you start operating, when you start selling your goods and services. That's where your profit and loss comes in. So, yeah, to answer your question, the $100,000 is never deductible per se, other than the fact that you buy property, plant, and equipment that you depreciate, and you buy inventory that you sell and such. That's where you generate your profit that you pay tax on, or hopefully don't end up losing money.
Okay, so then let's go to, what if they are paying themselves back that investment?
Paying themselves a salary, for instance, or
no. What if at the end of the year they give themselves 50,000 of the 100 back? Can they do that?
Well, let's see. Short answer, yes, but you've operated for a year, so you hopefully generated some profit. So your equity goes up by the amount of that profit. Let's say they made $20,000. Your equity then at year end would be $120,000. Of course, you pay tax on that $20,000. Okay, on LLC, it flows through to your individual return. But you could take, if you get strong enough cash position and everything that you felt you didn't need the extra $50,000 in there, you could definitely withdraw that tax-free.
Okay. And so that's not counted as a wage expense, or it's really not counted as income to themselves if they do it correctly.
It's a return of capital, yes.
Okay. And
Eddie, what do you think are the 2 or 3 things that businesses do wrong when projecting their finances? The reason why I'm asking is because we got some people starting new businesses on watching, and I want to make sure they get it right the first time.
Yeah. I think people underestimate the competition they're going to have. They don't make a good assessment of what's out there and who's doing what they're doing and maybe doing it a little bit better. we here at Food City try to run the best stores in town, and we try to live up to that so we can steal market share from other providers of groceries. So I think that's very key, that you make sure that you understand your competition. And then don't be overly optimistic when you're forecasting your sales. You're starting out, you have to ramp up. So typically what happens in a business, they generate losses as they're ramping up. Of course, they can't get to a break-even point where they start making any money. So you've got to be able to take that in consideration. That's why the monthly budget that I say should be done would illustrate that, and you can see where you're losing cash as you ramp up. Of course, it costs more money as you have to put it into the business to fund those losses till you start making money. So I think that's what I would just make sure you can understand your competition and that you are realistic in your sales and forecast for your goods and services.
So, Sandy, I can't see if there's any hands raised or any chat. Eddie, can you stop sharing the screen?
Yeah.
Okay. So last night they had some questions about LLC versus sole proprietorship, and I'm not positive that some folks understand that the only difference is the liability. So can you kind of tell them how it affects their income taxes?
Yeah, quick overview. Sole proprietorship is exactly that. You typically file a Schedule C in your tax return. I'm not a tax expert, so don't want to lead you down, take this for gospel, but I think it's pretty close. So your sole proprietorship, you have a Schedule C, and you pay the income tax on whatever that business generates. LLC, as you mentioned, Kathy, does provide you with some limited liability. If you are the only member of that LLC, say you started your own business, Kathy, and you're the only member in that LLC, you put your own money, that's ignored for tax purposes, and that essentially ends up in your tax return through a Schedule C. So if you have more than one member in the LLC, it becomes taxable as a partnership, and the earnings and losses are distributed out to those owners via their percentage of capital in the company. And that flows through their income statement, their tax returns in a separate line item for generation of LLC income and stuff. So the really the difference is, I think, it's the liability associated with it, especially if you're a sole proprietor. I think it's good to set up an LLC, even though it's ignored for tax purposes. You don't have to file your own return. You just let it run through your personal return, but it does give you that liability in place.
Okay, thank you.
Janice, I saw you had your hand up. If you want to ask Eddie a question, I unmuted you.
Okay, I do actually. The question I have is, doing a pure startup, looking at your competition is pretty easy to do, but how do you ascertain your projections on sales? For instance, if it's a kind of a hybrid of things that are currently existing, but very different, how do you go about that? You can't exactly ask the competition, hey, how do you do every month?
Well, you could do this. You could go to the competition and look and see how they're pricing things. We do that occasionally here at Food City. We'll go to other competitors just to see how their pricing is, and let's do a little gut check of that. But typically, you should be able to look at things on Amazon or whatever. That may be your best competition to look at, what things are selling for there, to try to set your price. So, and if you know what it cost you to develop your product, then from there you can sort of work from your cost and add a markup to that to see what you have to sell for to break even or achieve a profit based on your given sales level. So you can do some what ifs there, Janice, on that basis, as you play around with your profit and loss statement, to sort of factor those things in and see how it looks. And you can come out then, okay, if I'm selling 1,000 of these at $30, here's what I get. if my competition's selling at 27, here's what I look like. So just do a lot of what ifs on that basis.
Thank you.
Anybody have any other questions for Eddie? This is a fantastic opportunity. Speak now, forever hold your peace.
Okay, well, Eddie, I thank you very much for participating in our new knowledge. And Sandy is going to share that with all of us and all of our contestants so that they can do their own projections. And Eddie, will you give them your preferred contact information if they have if they need help?
Let me give you my personal email. It's ewalter0143 at yahoo.com. And my cell phone number is 423-360-9780. So feel free to contact me at either one of those ways, and I'll be glad to answer questions for you or share some information for you that I might have otherwise.
Well, Eddie, I want to also say thank you for sharing your expertise. I know you've got a lot of irons in the fire, and I appreciate you taking the time not only to prepare for this, but for presenting. But most importantly is your offer to share your knowledge with the other folks that may be that's online with us and seeing this later to offer your help. I really, really appreciate that. That's the kind of corporate citizen that we like in Washington County and the region. Just want to give a reminder that today's session was recorded and it will be on the Virginia Highlands Small Business Incubator's Facebook page and also on our YouTube channel, New Knowledge. You can go there and you can find, give me a couple hours to get them uploaded, but they will be there. Just want to give a plug for our next New Knowledge that will be on February the 9th, and that will be focused on setting up a tourism business. That is something that is growing in Southwest Virginia and starting to make a real impact in the region. So if that's something that you're looking at to explore now, or you want to look at expanding your existing tourism business, I hope you will join us on February the 9th. And that will be Jacob Bauer with Virginia Tourism Corporation will be leading that session for us. Thank you. Stay warm, stay safe, and hope to see you in a couple weeks. Thanks, Eddie. Good to see you.
Thank you all.
Okay, bye-bye.